This is Rick Rule with a special today for the Rule Classroom. I'm delighted to have those of you who are attending the classroom and taking the lessons. I'm really delighted to bring this presentation to you. Those of you who have joined me for the last several years in the uranium adventure will have enjoyed NexGen, and you will be aware of various controversies surrounding NexGen, in particular, a recently completed financing. I've been a beneficiary of Leigh Currier's activities in natural resources, including NexGen, for some time. And I have to disclose conflicts of interest. I have been and remain a large NexGen shareholder, so I'm predisposed to think kind things of Leigh. The fact is, however, that not all of the market sentiment surrounding NexGen and Leigh is as kind as my own sentiments. To his credit, Mr. Currier reached out to me and said one place that he might be able to have a forthright discussion concerning this was at the Rule Classroom. And I thank him for facing up to the difficulties that he is confronted with right now. And if you will, having it out with the market. I'm going to ask him questions that are partly mine and partly questions that have been reflected in social media, not the outlandish ones. I'm not going to deal with the Trilateral Commission conspiracies around uranium and all that kind of hocus, but the more commonly expressed complaints. First of all, Leigh, thank you for your efforts on behalf of natural resource investors, and thank you, too, for being so forthright in engaging with the community about the current circumstance.
Yeah, thank you, Rick, and I'm available always to transparently convey the good news story that NexGen is, and look forward to the opportunity to speak with you today.
Let's talk something about your background. What is it that caused you to become the CEO of NexGen? What is it in your past that equipped you for the success that you've enjoyed in the last decade?
Yeah, well, I was originally a chartered accountant, Rick, and I started in mining in 2002 as the chief financial officer of a small uranium company called Southern Cross Resources in South Australia. And I arrived there at a time that was halfway through feasibility and permitting. And I spent 4 years there with respect to advancing permitting and feasibility, and also the Indigenous relations with the local Aboriginal communities. And I learned an enormous amount about the industry, and I was always intrigued with respect to mining. After we successfully merged Southern Cross and with our fleece and formed Uranium One, which went on to become the second largest uranium producer in the world, I left and I spent the next 4 years with the world's largest private equity firm in the energy sector with First Reserve, where I headed up their nuclear investment platform called Nuclear. And I looked at uranium projects right around the globe from a technical, sovereign profile and also economic perspective. And I learned one big factor during that time was that the world had a couple of A-grade assets in MacArthur River and ERA, the Ranger project in Australia. And then there was a significant gap to the next best. And those A-grade assets that I mentioned give them an A+. The next best assets out there were a D-. And that's just the uranium landscape with respect to mine supply at that time. And so with the 2011 tsunami, I saw the opportunity with a very low appetite for uranium to found NexGen. And I specifically targeted the Athabasca Basin because it's the world of the home of A-grade assets. The deposits on average are around 100 times that of the rest of the world's production, but they're difficult to find. And at that time, in 2011, 2012, acquiring property, I picked up a very substantial package off Mega Uranium in the southwestern section side of the Athabasca Basin. And as everyone aware of uranium in the Athabasca, all the producing mines are on the eastern side. And myself and the geology team led by Andrew Brown at the time took the simple view that the geology in the southwestern side of the basin showed very similar characteristics to that of the east, but it was against popular convention at the time, and but we were very fact-based driven, had done a lot of research through the Geological Society of Saskatchewan, and spoke to a lot of geologists and targeted that property, went about developing some targets, and on the 21st drill hole on the property, but the first drill hole on this particular target where there had not been drilling for a 4.5 kilometre radius, we hit the Arrow mineralisation. So that's the genesis of the company and what led to this fabulous discovery in Arrow. And it was against popular convention geologically at the time. Who are these guys from Australia going to the other side of the basin? There's no mineralisation over there. And well, we did find what is the world's, one of the best projects in the world with respect to resources, full stop. But in uranium, it's clearly, when you consider its grade, its size, and then also its elite technical setting, being in competent basement rock with exceptionally clean metallurgy, it delivers just phenomenal economic returns. And in resources, there hasn't been a story like this. I think the closest one would be Voisey's Bay. In the last 30 years, that is slightly analogous, but in terms of upside and impact that this has for shareholders, this absolutely shadows the Voisey's Bay Diamondfield story, and we're on the path to becoming a top 10 world mining company based on the feasibility study economics, and depending on your view of uranium, even at $50 a pound, we'll be entering in that top 10 of world mining companies on an after-tax cash flow basis.
My understanding right now is that not the spot market, which is probably illusory, but rather the term market, that contracts are being written with floor prices of 70, 72, 75. Can you give us a sense of what this project would look like financially were it termed out at $75? You talk about a project with an economic impact that rivals Voisey's Bay. Talk to me about reserves and resources here, and the net present value of the deposit relative to the enterprise value of NexGen.
Yeah, so it will shadow Voisey's Bay in terms of economic return on investment. We have 350 million pounds approximately of global resource at Arrow. The feasibility study shows that we'll have a cash cost in the vicinity of $10 US a pound, and at $75 a pound and producing 30 million pounds per annum, which the project is capable of doing, and that's 30 million pounds, around 25% of world's current mine supply. And at that $65 margin, we're going to be hitting, net cash returns of around 1.8 billion US after tax. It's 30% tax and the various after payback periods. You're looking at an after-tax cash flow at $75 at approximately 1.25 billion US a year. So that, and looking at the comps of mining companies that have that type of after-tax cash flow, their market capitalizations are in the vicinity, or their enterprise values are in the vicinity of between 30 and $70 billion US. So that is the trajectory that we're on. It is dependent on concluding the federal approvals, which we're in the final stages of. And it is really the gate of realizing those types of returns. But it is a real economic phenom in the resources space, and very dependent on us concluding the federal permitting process.
we've had discussions with Robert Friedland and others about the difference between, net present value valuations. First of all, it depends on the start date, and we'll talk about that. What the point that Robert's made is that net present value calculations don't take into account cash flow enjoyed after 10 years, at which point you restart the net present value calculation at the same number that you started off with, which is to say that you
Yep.
understate the tail value of the deposit. Do you have a sense of what the start date should be if one is doing a net present value calculation? If somebody's using 1.2 billion a year, discounting it at whatever discount rate you think is appropriate, um, what is an appropriate start date? I think that's a very relevant
Yeah.
question. And what upfront capital costs? I realize that the upfront capital costs in the feasibility study are taken in the present value. I don't want you to count them twice, but I do want you to enumerate them. What are the upfront capital costs? What percentage debt? What percentage of equity do you think? And what would be an appropriate start date?
Sure. The start date will be dependent on us concluding the federal permitting process, and we announced 2 weeks ago that we've submitted the clarifications around the final 49 aspects requiring further clarification. We've submitted those answers. We're very confident with them, and we'll have an answer within 90 days from the CNSC. And we are expecting that and respecting the CNSC's review process, obviously, that the EIS shortly thereafter will be deemed final. There will then be a commission hearing date and then subsequent approval. I think a reasonable time frame around that is by year end or early 2025. And on that basis, but it obviously respecting the CNSC's timeline, on that basis, it'll be, as per the feasibility study, approximately 40 months through construction and commissioning. So we're looking at a time period of 2028, early 29 with respect to a start period. And with respect to the capital costs, as per the feasibility study in 2021, it stated $1.3 billion Canadian. Now, the inflationary impact on that 1.3 billion is around $320 million as we speak. So we're up to 1.62. And then with some final design aspects, which we're incorporating in the long-term interests of the project, because we're permitting for an initial 24-year mine life, that'll add approximately $400 to $450 million. So we're looking at a revised capital cost of around $2.2 billion, $2.1 billion Canadian. And with that, and at the current spot price of, I think it's $88 a pound at the moment, the payback period is still around 1 year to 15 months. So it has an exceptionally quick payback. And with that type of economics, the project can sustain a significant amount of debt. Now, we have run a formal process with respect to that debt. It currently stands of expressions of interest, formal expressions of interest of 1.4 billion US, which is approximately 1.85, 1.9 billion Canadian. On top of the 630 million in cash that we currently have, we have currently in excess between the cash that we have and if we were to trigger and formalize that debt, sufficient funding in order to complete the construction of the project, subject to receiving federal approval in the latter part of this year or early next.
So, one more question before we go into the conflicts. How much money does it cost you to keep the company alive between now and the time you start construction? and what is it that you can do to restrain costs, which of course uh, arguably potentially dilute shareholders' interest ultimately in the deposit? What will it cost us in expensed, not capitalized stuff around construction for the next 5 years
sure.
while the project is in gestation?
Yeah, so in terms of the NexGen platform, in order to advance this project through permitting um, prior to construction, and so there's a lot of work around the permitting that is going on. And as per our audited financials for 2023, we have a cash cost per annum in 2023, which was approximately $40 million.
Canadian or
There is
US?
Canadian,
Canadian, thank you.
yeah, and that $40 million relative to it's always important to put what is the cost in the context of the size of the activity that's been undertaken. And with respect to our exploration and development activities, we are spending a ratio of general and administrative expenses in total that are approximately 1/9 of the industry average for our peer group. So we have a very low G&A relative to exploration and development spend relative to any of our peers. And now that's the chartered accountant in me. We assess ourselves on cost relative to outcome. And then when you look at that $40 million in G&A relative to our market cap, it represents less than 1% of the market capitalization. Well, actually less than 0.5% of the G&A relative to our market capitalization. As per, and I would encourage everyone to look at our management information circular, particularly pages 50 through to 60, where it shows very transparently, which we have provided the market, and that it shows our share price returns year on year. We've basically been averaging 55% per annum over the last year, 3 years, 5-year period, and around 2,485% since incorporation. But that's great returns. You've got to put it in the context, well, what is the cost structure as we're addressing? And as I said, our raw G&A is for 2023 was $40 million. Now, we have approximately 90 employees, and we are building out the team in advance of receiving that federal approval in order to go immediately into construction. We have all the early items of construction fully engineered, and we literally can start construction the following week we receive approval. And we are building up to that. And obviously we're incurring a larger G&A this year as we did the year before as we get closer to that. But it's still very, very low as a ratio of overall exploration and development spend, and a very, very low ratio relative to our peers on a market capitalization basis, which is two real key metrics that everyone should be looking at in terms of assessing the cost versus benefit of spending a particular dollar.
Let's dive into that. First of all, who would you describe as your peers? You talk about a peer group company of 9 companies. These are development stage companies. Who is this universe?
Uranium peers. So there's uranium development companies located in Canada, the US, and Australia. And then also we have has a relevance towards also uranium producing companies as well. And then we've also looked at companies with similar market capitalizations in the mining sector in the other metals as well. So we are providing that information very transparently in our management information circular, and it tells a very accurate, and all the numbers are audited, independently reviewed, and it tells that not only are there phenomenal returns at NexGen, the method and the approach in which we choose to spend the money, be it community programs, be it in the ground, be it on permitting, all factors are very, very relevant when getting a resources project into approval, which we have. We have the provincial approval already, the fastest one that has ever occurred for a uranium project in Saskatchewan, and the first one in 20 years. So there's funds deployed on both the general and administration and the exploration development of this project, and it reflects us progressing well through those milestones and on the cusp of achieving our greatest milestone, which is the conclusion of the federal approval, which we believe is very imminent.
Leigh, you described 40 million G&A as low relative to project expenditures. What were those project expenditures roughly? What does low mean?
In total, last year, project expenditures were around exploration development is around nine times that of the G&A spend. So we have a ratio where we're spending effectively 0.43 of a cent for every 0.43 cents per dollar of exploration development spend. The industry average of that peer group is actually about $3.50. So we're operating at about a ninth relative to our peer group.
The lender in me, which is to say the paranoid schizophrenic in me, always asks if there's a double count. Does the non-G&A expenditure include a G&A charge? Are you double counting?
Nope.
Okay.
I'm a chartered accountant. I understand exactly that. I used to lend money myself. If we also look back, it's not just last year, Rick, but it's also every year since incorporation. To date, we've spent about $489 million on the project, and we have a market capitalization of approximately $6 billion at the moment. So we have a very tight fiscal discipline around every dollar that's spent. We are increasing our costs. There's no doubt about that. We're employing new people all the time in readiness for this federal approval, and we don't want a situation where we get that federal approval and then have to muscle up. It also reflects, Rick, our confidence in that permitting timeline, and we are gearing up so we can literally get into construction the weeks following that federal approval. And so, there are increases in the G&A to prepare for that event, which we're very, very confident on. I think it's also important to note that in that G&A audited figure, there's one-off corporate development and professional fees that we incur behind the scenes. So, that's all also leading into the securitization of the debt, other corporate development initiatives as well. And so the raw running cost is actually a little bit lower than that as well.
Some of the criticism has involved non-cash compensation, the option structure, and the possibility of RSU. Could you describe the options program at NexGen and talk about other forms, if any, of non-cash quasi-equity compensation?
Yeah, sure. So we've used stock options as an equity incentive for employees of the company. And I think that's really relevant for a company that's not yet generating cash flow. And the history of the way NexGen implemented that is that we've only ever granted options at a price higher than the prior capital raising. So employees have a higher price than what investors did in terms of a hurdle. Secondly, they're 5-year options. They have a time life of 60 months, and they only result in a gain to the recipient of those granted options if the share price at that time in the 5-year period is higher. Now, the executive have only ever exercised options in the 60th month, just prior to expiry. And with respect to myself, I've always paid the tax on the gain, and then also not taken all the money off the table. I've reinvested back into NexGen, and since incorporation, I've increased my shareholding on a share basis by over 3.25 times. Now, I don't know of another company that's exhibited that type of philosophy, which preserves the cash for exploration development. DSUs and PSUs actually require a company to use the company's treasury to grant equity in a company, and that equity is granted irrespective of performance. And I don't think that is in the interests of shareholders in a company that's not yet generating positive cash flow to be using the treasury to issue equity to the team. So we're very transparent. Use of options, it's completely the TSX guidelines is no more than 10%. We've never been over 10% of the issued equity that has been issued in options to companies. But the accounting treatment of those options is there's a Black-Scholes non-cash expense that's been applied to them. And I can tell you, my salary was once quoted at $21 million. I didn't earn $21 million that year. The impact of that was that I got called by a whole host of charities looking for a donation. So it needs to really be assessed on the cash component, and the employees or the recipients of those granted options only receive something if the share price has been significant in that 5-year period, or by the end of that 5-year period.
I'm sorry, those options that you describe as never exceeding 10% of the issued and outstanding of the issuer, are there other forms of non-cash or equity types of compensation other than the options?
No, none.
Thank you.
And it's all fully disclosed in our audited financials.
I just want the audience to take note. I've paid a lot of attention to the online discussions, not all of which is accurate or transparent. Let's go to the financing now, because that's sort of what I think instigated the firestorm. So let's work through that. You described yourself as having $630 million in cash. Does that include the most recent financing?
Correct.
In other words, was that financing, from your point of view, necessary in conjunction with the production finance, and was the utilization of the financing to purchase uranium after a fairly substantial run-up in the uranium price, was there a strategic or tactical component around the allocation to uranium having to do ultimately with the acquisition, say, of term contracts or other forms of production finance? In other words, tell us about the financing. On the outside, it looks pretty generous. I wish I would have been in it. 9% yield and convertible. Tell us why that was in an existing shareholder's interest.
Yeah, sure, Rick. So there's been 2 financings, and effectively, and we did that in close succession, which I think did surprise some elements of the market. The first one was a CDI on the ASX. We've been very, very open that we're exploring new shareholder markets. That's in the interest of all existing shareholders to find new shareholders the whole time. And the ASX are showing enormous demand and interest in the NexGen story as we conclude the federal permitting process. We went out to raise 200 million Australian and ASX only offering, and within 90 minutes we had demand for 515. We took 250 of that, so we upsized to 200 to 250 Australian and closed that. Now, one of the benefits of that financing is not only did it increase our treasury by 250 million, it also created significant liquidity on the ASX, which has the advantage of ASX 300 inclusion, and then we're on track for ASX 200 inclusion in the latter part of this year. That's in the interest of all shareholders. The second one, we purchased 2.7 million pounds of uranium, and we purchased it at $1.35 US below the spot price the night before. And we acquired it off a financial fund, that MMCAP, that had acquired pounds over the previous 4 years. Now, our decision to purchase uranium is consistent with every other uranium developer startup. When starting up a uranium mine, we are currently negotiating contracts for delivery in 2028, 29. And utilities, the security of supply and the confidence around delivering by a certain time is very, very key, because they can't go back 4 years into the past to reprocure if there's a miss. And so with uniquely with a uranium startup mine, having pounds on hand to help mitigate that risk facilitates enhancing your ability to contract on more favourable terms the actual mine production that you're going to do over the ensuing years. And that is a pure function of starting up a uranium mine, and also reflects, though, the elevated anxiety that utilities are experiencing with respect to their security of supply. They're seeing the world's major producers running inventory levels which are less than a third of what they were 2 years ago. They're having concerns around security of supply, even with the contracts that they have currently in place. And so that can only be determined if you're actually at the coalface of negotiating these contracts. We are responding to it. We're showing the utilities we have their backs, and that we've mitigated that timing risk if there is a delay or the construction is longer than what was previously forecast. And so, as I said, the decision wasn't a speculation on the uranium price. It was a fundamental of starting up a uranium mine. Now, once you take into account that aspect, how did we buy the uranium? Well, we bought it at $1.35 US less than the spot price the night before. And we issued a convertible debenture in consideration for that. So we didn't dip into our existing cash reserves. And we received we priced that at a 30% premium to the current share price 5-day VWAP at the time. So that's in the interest of shareholders as well. There is a 9% coupon, 6% in cash and 3% in shares. Now, from a cash perspective, we're talking $15 million a year on that consideration. The uranium price only has to go up $5.40 in the next 52 months to offset that entire cost of that convertible note. And I think anyone who's investing in NexGen knows that we have tremendous leverage to a rising uranium price, and that's part of the reason you're investing in the company. And so, on balance, that is a very, very strong financial deal. The aspect which I think some shareholders couldn't understand was the share price reaction at the time. Now, the night before we announced that transaction, we'd hit an all-time high valuation in the company's history. We had also led all the charts in terms of share price performance, month to date, year to date, 1 year rolling against our peer group in the uranium space. And what had occurred on that day of announcement was that Leigh Curyer disposed of his remaining 4.5 million shares on that day and the ensuing couple of days after announcement, because his trigger was the new all-time high. And there was that sale, which I think some shareholders thought, oh, there's other shareholders who think that that's a bad deal, and so they're selling as a result. It was a completely unrelated circumstance, but coincided precisely at the same time. And for full disclosure, Leigh Curyer, back in September of last year, had just over 9 months ago 70 million shares. We have orchestrated that sale very, very succinctly and still led all of the share price performance metrics against our peer group up until that day, and also raised about $500 million in the process. So I think, the opportunity to clarify some, or provide some additional information. That transaction is has put the company in a far stronger position today than what it was the day prior to announcement. And we've subsequently had the Russian uranium ban come in as after we did that announcement. The aspect around available supplies for US utilities is it's a new era in the uranium market. And I am extremely certain that the merits of that transaction will be appreciated by shareholders in the very near future. In fact, it's already happening. I've had a lot of shareholders say they've gone and bought more shares as a result. So, there was some misinformation out there, and having the opportunity to provide the rationale.
Yep. Leigh, thank you. You were cutting in and out there. So I'm going to push back a little bit, although I'm delighted to hear you describe the financing as a strategic financing. With regards to leverage, I personally felt that the 350 million pounds I had in the ground provided me pretty good leverage. But I'll leave you a little bit of license there. And by the way, nice pass by Mr. Leigh. Not that he necessarily.
He made approximately 700% return since investing in 2016. It's been a fantastic transaction for him and a fantastic transaction for us. And
for you,
look, the basis of our convertible note to fund the uranium purchase is on the same terms that we did with Mr. Leigh. We've done with Queen's Road Capital and also Sol Patterson's out of Australia. And so it's an instrument that we're very, very familiar with and we've had enormous success with. And I think when you're feeling from or looking at it from a dilution perspective, on all those transactions, we've always priced it at a 30% premium to the share price at the time. And so that's what I think is paramount in any decision around the consideration of financing.
You describe an entity that at today's uranium price, with your feasibility study, that could conceivably have a market capitalization of $30 billion, higher than the net present value, but I get the valuation discrepancies. Tier one assets are, as you describe them, fairly rare. Given that, and given the fact that you have enough cash, likely with the ability of this deposit to attract debt on favorable terms, and in particular, given the flexibility that you have with the existing inventory, to enter into supply contracts with investment grade counterparties, which would reasonably constitute additional security. Um, is it right for me to assume that any future financing that you did pre-construction would be dilutive relative to the extent that you say that at full production, that the deposit would likely generate a company that was worth $30 billion?
Yeah, depending on the timing of the federal permit, on the basis that it was going to be by the end of this year or early next, uh, we don't see a material um, equity financing in the future at all. So I would say the possibility of that is very, very low. And I would also say the materiality of any financing would be very, very low as well, based on what we have in cash at the moment. We also, have a liquid asset in £2.7 million that currently at $88 a pound, going to 125, will actually provide further leverage, which would be in the interest of shareholders as well. So as we speak, I see that the probability of any material financing equity-wise in the company's future prior to realising net cash flow is extremely low. And if there was, it would be extremely immaterial.
One final question before we need to wrap it up. There's been some discussion about the fact that you may or may not look to grow the company via acquisition, or that you may sell the company. That would suggest that you have a net present value calculation per share in mind. I won't ask you to describe that. I understand that that is material, non-public information. But could you talk about speculation that you might acquire somebody else, or in fact be acquired pre-build?
Look, we're always considering M&A, and it's my job and the team's job to ensure that we have both avenues covered off adequately. So for those, we approach every day on the basis that we'll be the ones constructing, operating, and closing the mine. Now, I may not be alive back by then because we're going for a look. The mineralisation in the area is extensive. As you know, we've also hit a new discovery 3.5 kilometres away, which looks better than Arrow did at the same time. But we approach every day on the basis we'll be the ones closing the mine, and that's in the interest of optimising the potential value of this project. There's no doubt though that having a profile of being in a tier 1 jurisdiction, a environmentally elite mining asset, also economic returns which are phenomenal, and with a metal that will take off the equivalent of 70 million vehicles of CO2 equivalent a year, is going to attract the interest from not only mining companies, but also oil companies, because they are effectively energy fuel providers. And we've seen that back in the 80s, that oil companies owned a lot of the uranium projects in the US. So there's no doubt, as we get through the federal permitting or conclude the federal permitting process, the attention on our company and the desire to acquire it is going to increase. We simply have the view of this. Any approach would need to be compared against what we can do ourselves. And we have a very good understanding of what we can do ourselves. We understand the value of a project like that and the current market comps between 30 and 70 billion. That's approximately 5 to 14 times higher than where we are today. And we're on track to deliver that in 4 years' time. That's even with the uranium price staying at $88 a pound. If it goes to 150, 200, as what a lot of people are saying, $205 is the inflation-adjusted historical high. And I can tell you, back in 2008, when it did hit its previous high, there was 5 mines which all had long lives ahead of them in the uranium supply, mine supply. They no longer exist today. So there's never been more fragility around the ability of world mine supply to react. And so I think the price based on that has the likelihood of going through $200 US a pound. And again, I'm a chartered accountant. I'm very financially fact-driven in my investment approach. So we are on track for that. And if someone was to come along and look to acquire the company, it has to be better than what we can do ourselves. And from an M&A perspective, it's important that the target has the ability to develop the project on its own. Now, we are attracting the brightest minds in the industry from all around the world. They love our approach. They love the technical approach towards safety and innovation and the elite environmental aspects. The financing of it, we can do it independently as well. So the good news for shareholders, if they are, thinking whether we do it ourselves or a potential acquirer comes along, they're going to optimize what that is at that particular time, because we are demonstrating that we understand and we can execute on delivering a company that will have, a market capitalization between 30 and 70 billion at the current uranium price once in operation.
Leigh, thank you for facing the discussion around your company head on. Thank you in particular for doing it at the Rule Classroom. I personally owe you. It's delightful that you've chosen our forum to have this discussion. Should investors want to learn more about your company, who might they contact and how might they contact that person?
Yeah, and thank you, Rick. Look, your forum, I have an enormous amount of respect for. You've been with us since we were an explorer with no project, and we're now on the cusp of federal permitting and unlocking those phenomenal returns. So I really appreciate this opportunity in your platform right throughout, not just today. We have, depending on where you are in the world, we have Monica Crass is our world corporate investor relations head. And then we have in Southeast or Australasia, Stacey Golkin as well. But our website has all the information to contact the company, and you'll receive a very expedient response. We have a lot of eyes on us. We should have a lot of eyes on us. This is a good news story in an environment that is tough for resources, and the impact of this project being 25% of the world's production, probably 50% of the Western world's production when in operation at a time that energy policy is absolutely paramount across the world. As I said, I think this is the best story I've seen in the last 50 years in the resources sector. I feel privileged to be a part of it, and I'm very, very appreciative of everyone in the NexGen team and their commitment, shareholders and our consultants, our suppliers, and the communities in which we work. Everyone is dedicated to delivering on this generational project.
Well, Leigh, we're going to have to leave it at that. Thank you so much for having this discussion. I have many, many, many reasons personally to wish you every possible success. Thank you again.
Thank you very much, Rick.